Hey everyone, doing job there. DFX forex swing trading. Taking a look at the situation on the Kiwi Japanese yen. Here we see, as we normally started with the overall picture of the currency pair that we're looking at. This overall scenario shows that we have actually been in a very strong uptrend since 2008, 2009. Following this sharp movement and strong movement in favor of the Kiwi dollar, we now see that the pair finally is now taking a significant break, so to speak, and has now broken the inner uptrend line. This actually took the form of a bear crown setup, otherwise known as a head and shoulders formation. And here we see that the left tip or the left shoulder was formed at this area here, with the center tip and the center tip or the head at this area, followed by the formation of the right shoulder or the right tip that led to the final breakup below the inner uptrend line. Now, generally speaking, whether we're talking about movements on the daily chart, 4-hour chart, or 30-minute chart, whenever we have a break of an inner trend line, there's normally the movement normally takes place and carries us towards the outer trend line. This is all the more likely if the setup that led to the breakout of the inner trend line is as strong as this formation here. Naturally, the larger the time frame and the larger the significant and the larger the setup, the more significant and reliable is the breakout and the expectation that it will in fact head towards this outer trend line. Now, theoretically speaking, once we're still above any trend line, there's always a possibility that we could see a resumption of the existing trend. So even though we're more likely to see the market continue towards this area here, there's always a possibility that we must bear in mind of a resumption of this uptrend line, of this uptrend. So with that in mind, we're gonna have to take this movement in stages and monitor the setups and signals that are provided along the way to determine whether or not we're gonna continue in this direction or have a change in movement to resume the overall uptrend. So we're going to have to take a look at the situation more closely to see what we have in terms of the next possible movement. Now, as you can see here, these three trend lines have actually been formed: an outer or long-term downtrend line, an outer downtrend line, as well as this inner downtrend line. Here we can see that we have actually taken a bit of a pause once again, and we have now formed what is known as a normal range setup. Now, given the more likely scenario of a continuation towards this outer uptrend line, we're very likely to see a breakout below the support area with a strong bearish candle. So if we see that in the next couple of days, then it's going to be it is very strong, and the setup on the 4-hour chart allows us to trade that signal, then we could get a very strong opportunity for a 200 pip trade that could take approximately 4 to 7 days to be hit. So right now it is going to be a bit dangerous for anybody to trade within this boundary. The size of this consolidation does not permit us to trade successfully or confidently within this boundary, because as you would notice here, sometimes it doesn't even go towards the other trend line, the other boundary, before you turning to go back to the other end. So there's a very strong element of risk in trading these boundaries of this size. If they were a lot larger, say for instance this distance, then we could talk about trading within them until the breakout takes place. But for sizes of this nature or smaller, the better thing to do is always to wait until we see a breakout in either direction. So given the overall scenario of this pair, the more likely situation that we see is a bearish breakout towards this area here, towards the outer uptrend line. Nevertheless, considering the bullish scenario as well, if we actually are to see a reversal that takes us higher, to continue the movement in favor of the Kiwi dollar, then instead of a breakout bearish, we would see a gradual break above this area here. That is going to be the first indication that we would not actually be completing the movement towards this outer uptrend line. So that is the scenario right now. The more likely scenario, a bearish break of this consolidation set up to continue bearish, or a breakout above this area here. Even if we get here at this area here, we could still see the market move and U-turn and continue bearish. That would be considered a false breakout movement and would lead to a continuation, lead to a reversal bearish in favor of the Japanese yen. So we would need to see a clear breakout above this area here for us to even begin to consider the bullish scenario. So let's wait until the next couple of days to see what takes place, and hopefully we can get a strong opportunity to trade this breakout. Hopefully in this direction, which would take a lot shorter time to reach its target than a bullish movement here. So until then, take care.